This podcast was made possible by the kind support of Alvine Capital Management, a London-based specialist investment advisor and placement boutique.
Variance is where the unicorns lie, and this is true for people as well. So when you think about variance in people, that's where those unicorn people lie, is in the variance. And it's obvious in our venture portfolio that we get it and we understand the value of it. I think diversity allows you to take advantage of that variance and find those people that are unicorns that you wouldn't be able to do if you were very, very predictive in what you were looking at and you were trying to pattern match. You don't get that level of diversity if you pattern match, and you lose out on the benefits of variance and diversity for both startups as far as returns go and people.
I'm Aoife Devitt, and welcome to the 50 Faces podcast, a podcast committed to revealing the richness and diversity of the world of investment by focusing on its people and their stories. I'm joined today by Steve Kim, who is a partner in investment strategy and risk management at Verdis Investment Management in the Philadelphia area. He has focused over 30 years in his career in implementing and managing operating infrastructures, and prior to his role at Verdis, he held various chief technology officer roles. He now focuses on integrating his insight from systems, modeling, and data analysis into an investment approach, particularly in the venture capital arena. Welcome, Steve. Thanks for joining me today.
Thank you, Ethan. It's a real pleasure to be with you today.
Let's start by talking about your background and how you ended up moving from a role as CTO into the investment arena.
So I started my career at the Walt Disney Company in information services. And most people think you need to be a really good programmer to begin a career in IT. But I was never really a good programmer, just really average. But what I was really good at was problem solving, and by extension, developing data-driven algorithms. The way I got my job at Disney, I developed several networking algorithms that Disney became aware of, and I was lucky enough to be offered a job. After Disney, I worked for Fujitsu and Alcatel in the telecom space, developing optical networking standards and algorithms, some of which are still being used today. And eventually got the chance to lead several private and public companies as CTO. One of those companies is where I met two of my partners to start the family office. And from my perspective, the investment arena was just another problem to be solved using a data-driven approach.
And in terms of, just want to dig in a little bit more, we don't have too many ex-CTOs on this podcast. What would you say are the key challenges facing a CTO today? And what's paramount importance at the forefront of your mind? Is it cybersecurity? Is it keeping up to date with the vast amounts of data? How would you characterize your priorities then?
It's a really good question. I think coming from a CTO or technical background or database background, I think there's a lot of pluses, especially if you've gotten that background from outside of the investment industry. You get to start from a fresh slate and you get to look at things from the outside in. But there are some negatives to that. For example, you haven't been in the investment management space, so you have to learn about the industry and how the industry works. So there's pros and cons to having that background and having started outside of the investment management space. And there's pros as well, as I just explained, that you get to take a look at it from a greenfield perspective and look at it from the outside in. You do get some advantages, though, as you pointed out, in things like how you build that infrastructure. The technology piece is such an important piece of the puzzle to develop and deploy investment services. And being in the data space and being in technology allows you to think through that infrastructure, the tools, the technology, the applications, the cybersecurity, et cetera. And that is a pretty big advantage.
And I'd love to move now to hear about the insights you may have gleaned from the modeling and data management work that you did, that you brought into the investment space and into venture in particular.
So there's a lot here, but I kind of boiled it down into one I think that is really, really important to think about. So the biggest insight I see is how stochastic or random market returns are. And the biggest surprise from my perspective, looking again from the outside in, was how much of this that is really ignored by the industry. So when you look at the data, it looks really, really random and stochastic. But then when you look at the products and services that investment managers typically have, they seem to ignore that randomness, that stochastic set of returns that you see in the data. And I think venture capital is a really, really good example of this. There are all these quantitative aspects as it relates to market data. And when you look at venture capital data, it has all these attributes as well. So you see distributions, you see power laws, you think about ergodicity, fat tail, skew, kurtosis. So there's a lot of technical components. But I think the following is a really good way to think about it without all the technology and to think about it more intuitively. Again, I'll use venture capital as a really good example of this because it's such an extreme asset class, and therefore it really relies on extreme variance or spread. You need to be invested in outliers, quote, the big winners. And another way to think about it is positive black swans. And let's just use the venture capital lingo and call them unicorns. I think it's a pretty well-known fact that you need exposure to these unicorns to get your venture-like expected returns. And these unicorns are really mirror images of black swans. And everybody is aware that black swans are not really predictable. Taleb, and there's a lot of work that was done. And I think there's pretty common knowledge now that you really can't anticipate these black swans. And we just recently had one, and we're still in that process with COVID and what's happening there. So intuitively speaking, tail risk black swans, for some reason, we think are not predictable. But when we think about unicorns, somehow we think they're predictable and they can be pattern matched. It's a really interesting thing to think about why we think that when you have a tail risk, that's not predictable, but these unicorns, which is kind of the mirror image or a positive black swan, that somehow we think those are predictable. And we spend an enormous amount of time optimizing for this particular pattern. When we do this, we're eliminating more and more of the variance, but we need the variance in venture capital. Again, because it's a variance-driven asset class, we need a high variance-based strategy. And here's a good example about how to think about it. If you look at, as most investment managers do in the venture capital space, and this is probably a small number, so we'll start there. If you look at 100 startups, you invest in 10, and you've picked 10 because you need to sit on boards or you need to help those companies from an operational perspective, and you don't have enough time to devote to 100 startups, so you're really eliminating down to 10, you're basically eliminating 90% of the variance. And as you scale that, if you look at 1,000 startups and invest in 10, you're eliminating 99% of the variance. The scaling optimization is a real problem in venture capital. For some reason, when selection is hard, we tend to optimize more and thereby eliminating even more variance. And the variance is where the unicorns lie.
That's so interesting. So it looks like we're being doubly fooled by randomness. On the one hand, not appreciating it, and on the other hand, thinking it only goes one way, as you mentioned, on the negative side. So what's the answer then to these findings that you have drawn from the data? Instead of going from 1,000 to 10, do the 1,000?
So we struggle with that too. So how do you scale and how do you take advantage of variance? And as human beings and as investors and analytical people, we tend to think about things and we over optimize. So we get narrower and narrower and we try to eliminate more and more of the variance. So the way we think about portfolio is we think about it as an aggregation decision. We don't want to over optimize and eliminate all the variance, but we know we need to have some selection criteria or some criteria to narrow that funnel to some degree. And the way we think about that is the answer that we came up with is really thinking about it more from a curation perspective, less so on an optimization and selection perspective. So when we think about curation, we're talking about finding appropriate pools where we want to invest and then allow variance to thrive in those pools. So we do narrow our selection to a certain pool and we use that curation philosophy, but then we want to be very, very diversified within that pool, as diversified as we can get to make sure that we can harvest all that variance that's there in that pool. We curate really versus optimize, but we are always finding that tendency to over optimize all the time because it's just a natural behavioral bias that most people have, and we certainly have that, but we try very hard to fight that tendency.
And it's interesting because often in a complex asset class like this, it seems that they are inaccessible to smaller clients, perhaps because they can't get access to that select, highly curated portfolio that many institutions might do. Often the only asset class that is available to a smaller client might be a fund of fund, and a highly diversified fund of fund at that. But this doesn't seem like bad news anymore. It seems like perhaps that is a suitable vehicle for the smaller investors if it is providing that diversification that you mentioned. What are your thoughts on the venture fund of funds that are out there, and should we all be doing it this way?
It's interesting when you think about venture fund of funds, it's really the only fund of fund strategy that works really well. They are somewhat curated because they have a set of GPs that they invest with. But when you aggregate a portfolio like that, you get quite a bit of diversification. So they are harvesting a lot of variance in their portfolio just by definition of how many GPs they invest with, and then the look through of the underlying portfolio to see how many investments they're really making. So if you look through those portfolios, you see the 15 or 20 managers that they're investing in, you multiply that by the startups that they're actually investing in, and you get a very, very diversified portfolio that is curated because they've selected certain managers. So it's a perfect strategy for venture capital. It's a great strategy for venture because of the distribution of the venture capital landscape. It doesn't work so well when you don't have that kind of distribution. So if you look across fund of funds in other areas, it doesn't work as well, but it does work very well in venture capital. And the data supports that. If you look at venture fund of fund returns, they're always better than the median returns of the asset class.
And how about private equity, say traditional buyouts, large or middle market? Is there any advantage there? Does that have a similar distribution?
It doesn't. So that's why we spend a lot of time on the distribution. And when you think about how we think about that is we want to understand the random patterns, the stochastic patterns first. So that's our baseline of understanding. And we look at that across all the asset classes, and they're all different. So if you look at just the private asset classes here, the distributions, the shape of the distributions are all different. And when they're different, you have to ask yourself the question, okay, what does the difference mean? And shouldn't I have a different investment strategy depending on how that distribution looks across the asset classes? And that's one of the things that we've spent a lot of time looking at the data to understand what that distribution looks like, because it's really informative on how we want to access that asset class and what our strategy is. So if you look at other private asset classes, they don't look anything like venture at all. In fact, venture is very, very different from a distribution standpoint than private equity buyout or even growth equity, real estate, oil and gas. You can go across the private asset classes and you can see how the distributions change. And the way we feel about it is if the distribution looks different, your strategy should look different.
Really interesting. I want to ask you also about the use of data in general in the private asset arena, because it does seem like it's a little late to the party in terms of using data. It tends to maybe give us an excuse that this is a relationship-driven business. It's not about quantitative number crunching. It's about who you know and how they manage money. Would you say that we need to be better about using data in the private arena?
We certainly do. I think we're only scratching the surface, especially in the private asset classes. In order for us to look at data the way we look at it today, it requires not only a lot of data, but it also requires a lot of computing power. So if you look at the intersection of data and computing power, it hasn't been very long. And if you look at a lot of the models that were built over the years, the models were really, really simplified. And the reason for that is because one, you didn't have near the data, and two, you didn't have the computing resources. Think about trying to run a Monte Carlo model when you didn't have computing resources. You'd have to calculate the probability distributions by hand, right? And if you had to do that 1,000 times, it would take you years to do it. So the models had to be really simple, and we didn't have a lot of data, and we couldn't compute any of the information based on that data because we didn't have the computing resources to do it. We had to do it by hand. So I think we are only scratching the surface. In private asset classes, I think we're just starting to build these large data sets. We certainly have enough computing power now, but we need to build these data sets in a more robust way in the private asset classes. And then there's also how we think about data and how we interpret it. I think that's also an area we're really only scratching the surface. And we're spending a lot of time trying to think about data and analytics in a predictive domain. How do we use data to predict results? We spend a lot less time on thinking about the stochastic distribution of the data or the random distribution of data and what that probability distribution looks like. And I think that's where there's a lot of opportunity.
And in particular, this is an area where a lot of information is deemed to be proprietary. It is private, and many funds and companies want to stay private for a reason. Is there an issue with any privacy concerns around data? Do you find that it's harder to get some of the data?
Privacy is always going to be an issue, but in many cases, we don't really need specific attribution here. I think we're at a stage right now where we can anonymize the data and remove any specific attribution and look at the data in aggregate and do the analysis in aggregate. This is also an area where if you take more of a stochastic view or a random view, the aggregation of data is really, really important. And getting that aggregated data allows you to perform that analysis and not be as worried about the specific attribution. Now, you need specific attribution if you're trying to be more predictive. And that's why I think there's all these privacy concerns, because what you're trying to do is predict A from B or B from A. And in those instances, you could need specific attribution. But if you look at it more from a stochastic perspective and look at the distribution, the aggregate data is really telling you a lot. And we use a lot of aggregate data in our analysis versus specific data that has specific attribution to it.
And from your vantage point now within an investment office, what's your perspective on the use of ESG risk analysis, engagement, ESG integration, particularly, say, the private market area, but across the board?
Yeah, so this is kind of from my CTO background. I think technology has really hyper accelerated engagement. It's crazy from my perspective how much we look at engagement now. We're constantly measuring it, tweaking it, nurturing it, seeding it everywhere. Everybody is focused on accelerating some type of engagement. And the internet can be a really democratizing force for good, where individual voices could be heard. But the problem with that is when you hyper accelerate engagement and you underpin it with the internet, where you get a bunch of individual voices, it's really difficult to coordinate these voices. So you get a lot of noise when those things collide. And I think that's where ESG is today. There's just so many voices around ESG, individual voices around ESG. And everybody's very, very engaged in the conversations about ESG and what it means for them and how they characterize it, how it should be implemented, how it should be measured, how it should be nurtured, how it should be developed. And I think we're at that stage where there needs to be a coordination here on what those voices should be saying and what those benchmarks should be and what those baselines should be. So I think we're kind of at that early stage with ESG where the internet and hyper accelerated engagement has taken over, but we need a level of coordination that's going to take some time.
I love that perspective of technology as an accelerant in this respect, because of course it's true. We know so much more now, with the transparency is so much more enhanced. And I suppose the cycles in which we can actually take action and make a difference are also accelerated. So it's an interesting perspective. Just drilling into one aspect of ESG, which is often talked about, diversity. You've moved from a CTO role into the investment management industry now. What are your perspectives on the current levels of diversity in the industry that you're in now?
This is where I think, from our portfolio perspective, where venture really shines. As a family office, we're invested across all the private asset classes. So we can kind of see through those portfolios and see what the diversity looks like across the different asset classes. And we've been doing it for quite a long time, over a decade now. So we've got a really good pulse on, does a particular asset class look from a diversity perspective versus another asset class? And venture by far has the most diversity amongst the asset classes we invest in. And we're talking about real estate, we're talking about growth equity, we're talking about buyout, we're talking about on the public market side, it could be a long-only portfolio or hedge fund portfolio. But if you look at venture, it's much more diverse than the other asset classes. And I think that's due to our focus on variance again. Since we focus on harnessing variance in our portfolio and we take more of a curation perspective, we get that diversity by default, and it shows up in our venture portfolio by default. We look for variance and we see it in our venture portfolio, and it shows up as diversity. Variance is where the unicorns lie, and this is true for people as well. So when you think about variance in people, that's where those unicorn people lie, is in the variance. And it's obvious in our venture portfolio that we get it and we understand the value of it. I think diversity allows you to take advantage of that variance and find those people that are unicorns that you wouldn't be able to do if you were very, very predictive in what you were looking at and you were trying to pattern match. You don't get that level of diversity if you pattern match, and you lose out on the benefits of variance and diversity for both startups as far as returns go and people.
I want to get back to some personal reflections now. When you look back at your career and the various moves you've made, were there any setbacks or challenges in there, or even mistakes that you've learned lessons from?
Okay, we can have a podcast session all its own on the mistakes and the setbacks and challenges. But I kind of want to narrow down on a couple here. And I think one of them is when you ask data a question, how counterintuitive some of the answers can be, and how some of these answers can crash really, really headlong with behavioral biases that we all have. That's one that we're constantly struggling with. And it's a huge challenge because you get some answers back when you do the analysis that you kind of shake your head at and say, oh, geez, there's no way this could be right. And you can have a strong opinion of why it's not correct, but the data is something, and you need to have an open mind about it. The other one is how much time is an asset. And being a family office, we get the luxury of time and certain endowments and foundations as well. But a lot of investors don't get that benefit of time. And time, it's a huge, huge asset that we always need to understand. It's literally the exponent in the compounding formula. And those that have the advantage of time are looking to compound capital over a long period of time. So it's really an important piece that you need to consider in your investment thesis and your strategy. Investment mistakes, there's been a lot of those as well. I think the big ones for us is just underestimating how powerful averages are. And another one is oversimplifying correlation. We hear about correlation all the time. In fact, it's rare that when we talk to a GP that they don't talk about how uncorrelated their investment returns are from X. And that X could be the S&P or ACWI or some other benchmark that they're looking at, or equities in general. They could have an investment strategy that says that they're uncorrelated to equity. So we hear this uncorrelation or correlation argument all the time. And correlation is very, very complicated. And when we think about it, we oversimplify it a lot, and we need to be careful about that. But those things kind of get into this whole discussion about over-reliance on reductionist thinking. So it's another behavioral bias that we need to fight, is that we tend to try to reduce things to make it simple so that we can understand them. And investment returns and people and modeling and everything that we're talking about is very complicated. And we need to worry about boiling those things down to make it too reductionist.
So much wisdom there. And I'm a huge believer in what you've just said in terms of the dangers of reductionist thinking. There's another famous podcast, Ted Seides, Capital Allocators, where he asks people about their pet peeve. And I think that has got to be one of mine, is that overly simplifying matters. And it's a thing the media does, and it's for sound bites. And it's because we're all time poor that we like to have simple heuristics. And I think that completely misses the point in terms of the nuance and the gray area that we all live in. So I'm very, very interested in your perspectives there. The other thing I'd also heard around the change in venture today is that in the past, capital was scarce and time was abundant. So people had time to do all the due diligence they needed, and there was not a lot of capital flooding the area. So basically, that was perhaps a more sound basis for decisions. Now it's the reverse, in that capital is abundant and the time period for making a decision is much abbreviated. So time is scarce. So that it perhaps also leads to hasty decisions and perhaps not a great deal of due diligence.
Yeah, the reductionist thinking, like I said, you can have an entire podcast on that. And it's a byproduct, I think, like you said, of human beings just coming up with a heuristic because it's so complicated. You can't think about all the nuances and you want something that you can make a decision on that's relatively straightforward. But again, this has to do with, being data driven, is that even when you tried not to be reductionist, without the data and without the computing power, you couldn't really do it. Now with data and computing power, your models can be a lot more complex and you can think about things in a more complicated manner. And in fact, the Santa Fe Institute is a great example of this. There's just a lot of thinking around complexity now and how to model complexity and how complexity should be something that you need to look at as you look at decision making in general, that you need to be aware of the complexities and think through some of the complexities as you're making decisions.
I'd like to turn now to any key people who influenced you along your journey.
So my parents were by far my biggest influence. When I came to the US, I was 5 and I couldn't speak one word of English. My parents, and this was a very expensive purchase for them in the days, bought me an encyclopedia set to help me learn English. And they said, look, you should read this because it's going to help you with English, but also from a knowledge perspective. It wasn't something that a young kid wanted to hear, and I certainly fought it for a while. But when I started doing that, when I started reading that encyclopedia set, it really ignited my curiosity about everything and my love of learning. And I really credit my problem-solving ability to this curiosity and this going through that encyclopedia set as a way of learning and being curious about just a ton of different topics. And it wasn't just one topic. I'd read something and want to read more about it and want to read more about it. Eventually, my parents got me another encyclopedia set, and I'd be waiting at the door to get the appendix because every year they'd come out with a new reference set or reference book that summarized the last year, because at that time you had to print those things to stay up to date on what happened the prior year. So that was a way that they would keep from being outdated. So I'd be bated breath waiting for that volume to show up so that I can get back to current on what was happening. But that was really huge for me. And then I've had really, really great teachers and business mentors. When I think about it, I've been very, very lucky in the teachers that I had and the business mentors that I had. They've been really, really important in my life and shaping kind of how I think about things and how I see the world and the curiosity that I have.
That's a wonderful story. I can visualize you there as a young boy waiting by the door. Certainly an investment that paid off for your parents, I'd say. Looking now at any words of wisdom, a piece of advice you received or creed or motto that you live by, what would you tell us there?
So these are my two big ones, and they're kind of corny, I guess, to think about, but I really try to live by these. And one is to be humble and kind. I think the more success you have in your life, the bigger the tendency that you stop being humble and you stop being kind. And I think it's really, really important that no matter the level of success that you attain, that you always, always remain humble and kind. And it's because people don't realize it, but a lot of their success has to do with pure luck, right? So I think it's really, really important to be grounded in that. And then always hold your opinions loosely. It's fine to have opinions, and everybody has opinions, and they should, but I think it's really, really important to hold your opinions loosely. I mean, that's the only way that you can let learning work for you and let curiosity work for you, is your ability to hold your opinions loosely so that you can learn and that your curiosity really pays off.
That, of course, corresponds with an aversion to reductionism, because if we don't reduce and we see the complexity before us, we may have to just adjust those opinions as new facts emerge. So I think it's very consistent. And my last question is around any advice you would have for your younger self. Anything you know now that you would like to tell that young man entering information services?
Okay, I have two stories here, and they're both extremely painful. So I would love to see somebody invent something for time travel, because I would love to go back and fix these two. One has to do with sell your shares after the lockup. So this was a really painful chapter in my life where I had the opportunity to sell some shares right after the lockup, and I got some advice to hold on to those, and it was for a number of different reasons. And I ended up holding on to those shares and not taking advantage of of actually selling those shares early, which was a pretty big mistake on my part that I wish I could go back and fix. So that's one of the things is if you have shares available to you, you might want to think about selling those shares after the lockup and